You're not stuck paying rent forever. You just need the right plan on how to start your home ownership journey. Here's 8 simple steps on how you can become a homeowner. My name is Sydney Jett and I'm a Georgia real estate agent. I've helped numerous of people become first-time buyers and break through their limiting beliefs. Let's start with step number 1 on how to become a homeowner. Step number 1 is you'll need to prepare your finances. How will you know if you can even afford to buy a home? You want to make sure that you have some steady income coming in for at least the past 2 years. If you don't have 2 years of work history, you'll need to show why that is. Let's say, for instance, you just got out of college. You can use your offer letter and your transcript from college to show that you were a student and now you have steady income coming in from your job straight out of college. Your credit score is going to be a crucial impact on the type of loan you get and at what interest rate. So the higher, the better. Most loans you can get approved for the lowest at 580, but 620 and up will definitely get you more favorable terms. To get approved for that loan, the lender or bank will be checking your debt to income ratio. That means they'll be dividing your total debt with your total income coming in each month. So let's say you have $2,000 for debt. That covers your car note, your car insurance, credit cards, student loans. And you have $6,000 coming in every month for your income. Your debt to income ratio would be 30%. Most lenders would approve you if your debt to income ratio is less than around 40%. For a down payment, you can put as low as 3% or 3.5% down depending on the loan. You can use your 401k, your savings, a gift from a parent, or down payment assistance to help you with this cost. I would suggest using a mortgage calculator to check what a monthly payment for a $300,000 house would be versus a $500,000 house, so you could kind of know what type of income you need to be having coming in each month. Now that you've looked at your finances and you think you're ready to start on this journey, it's time to hire a real estate agent. When you're hiring a real estate agent, you want to make sure that they are knowledgeable about the market, they are guiding you through the process, and that you trust, like, and respect them. This is going to be a long journey and it can be stressful and overwhelming, so you want to make sure you pick someone that you like to spend time with. This agent to sit down with you one-on-one to talk about your goals and strategize to help you find the best deal possible. Each agent runs their business differently, so make sure you understand what they can do for you and how their services can best help you and support you in this journey. It is now required now that agents have you sign a buyer brokerage agreement of some sort. It may vary state to state, but this document lays out how you guys will be working together in an exclusive relationship. They will be representing you in the purchase of your home. You want to make sure you communicate with your agent about the expectations of you signing that agreement and any fees that correlate with that as well. If you guys aren't in Georgia and you're looking for agents in other states, let me know because I do have a network of fantastic agents across the country that are looking to help you if you need any assistance. Step number 3 is pre-approval. When you start the loan application, you'll have to disclose your income, your assets, and your liabilities. They'll want to make sure that you're a reputable borrower and are capable of paying back the loan. During the pre-approval process, you want to make sure that you can verify your income with either W-2s, tax returns, bank statements, and pay stubs. You can also show your assets if you own any real estate properties like rental properties, if you have a 401k, or any stocks and bonds. When you meet with a lender, they'll also discuss the different loan programs that are available between FHA, conventional, VA, USDA, and jumbo loans. Each vary with the type of down payment and credit score, but most first-time homebuyers do go with FHA or conventional. Within the loan programs, there could be down payment assistance available as well. So talk with a lender and or a real estate agent to find out how much money you could be saving. And I know interest rates have been a big topic of discussion when it comes to being able to afford a home. As long as you have a monthly payment that you are comfortable paying, when interest rates drop, you can then refinance and get a more favorable interest rate. There are ways to negotiate even with the seller to buy down your interest rate by 1 or 2%. If you're interested in learning more about that, I can definitely make another video that goes more in depth about how you can get better interest rates in the market. So once you have compiled all the documents and all of your information about your income and your debt, the lender will give you a pre-approval letter. Now you have a lender backing you for when you start looking for homes in a certain price point. And a quick tip, just because a lender can pre-approve you for a certain amount doesn't mean you need to go to that highest limit. You'll also want to make sure that that monthly payment is comfortable for you so that you're not house poor and only being able to live check by check. Okay, so you have your budget, you have your agent. It's now time to start looking for homes. I'm sure this is everyone's favorite part. So before you start just going to every single house that's on the market, you're going to want to sit down and think about your wants, your needs, and your deal breakers. First, let's discuss the different types of properties. There's condos, townhomes, single family, and multifamily. You want to make sure that the house that you're looking for fits your lifestyle. Your needs could be the location, how many bedrooms and bathrooms, the price point, and any specific features that you may need. Your wants would just be the cherry on top to make it the perfect home. Now, deal breakers, these are things that you absolutely cannot move forward with. That could be a basement, you don't want 2 stories, you don't want to be in the city, you don't want to be in a rural area. Just discuss with your agents that they can compile a specific list for you so that when you start getting those listings emailed to you on a daily or weekly basis, they'll be more in tune with what you're looking for. Your agent should also set your expectations based on your wants, your needs, and your deal breakers. If what you're looking for isn't realistic for what's actually on the market, you could have some trouble finding the right property for you. You may have to compromise on your needs and wants and be able to adjust to a different location or a different price point that can best suit you in this market. Now that you've been looking at homes, you've come to a decision on which one is the right one for you. This is the time that your real estate agent should advise you on making a smart decision. There's a few things to consider before you submit an offer. 1, is there any background information that you know about the property? Has the seller disclosed if there's any issues or defects with the property that could cost you a lot of money to fix? 2, how has the seller and the seller's agent priced the home? Your agent should know the market in terms of what has sold in the area and how that compares to the current property that you're looking at. You don't want to submit an offer that's overpriced and costing you more money in the long run. Your agent should also communicate with the seller's agent to find out what could be the best way to win this deal. Is the seller looking for a fast closing? Do they need a longer closing to move out? Make sure your agent is in great communication with the seller's agent so that they can find the best way to strategize on your behalf. Now let's talk about what goes into an offer. An offer consists of the purchase price, any closing costs that you're requesting, the submission of earnest money, the closing date, the due diligence period, the finance contingency, and the appraisal contingency. And then depending on the type of transaction, there could be special stipulations or negotiations of realtors' commissions and compensation. So when you submit the offer, you're letting the seller know that you are pre-approved for a loan with a specific lender. That makes your offer that much stronger. After you submit your offer, the seller has a few different options. They can accept your offer, which means they like all your terms and you're ready to go under contract. Or they can counter your offer, meaning they want to change a few terms but are still willing to work with you, or reject your offer, which means they don't like the offer and are going to find a different buyer. Hopefully they like your offer and you guys go under contract and you can start with the due diligence period. Due diligence period. What does that mean? Once you go under contract, you're now in what's called the due diligence period. This is the time for you to conduct inspections to make sure that this is the right property for you. Usually this can be between 3 to around 10 days depending on what you put in your offer. When you're conducting these inspections with a trusted and licensed inspector, you want to look for the safety, systems, and structural concerns. If there's anything that will risk your safety in the home, you want to really take the time to consider if you want to move forward with the property. If there's anything wrong with the systems, with the HVAC system, the plumbing system, you want to have an estimate for how much those repairs would cost and to see if it's worth fixing or moving on to a different property. And then lastly, structural. These structural issues with the foundation could also be hazardous and cost a hefty amount to repair. All of these things you want to make sure and not be nitpicking on the small cosmetic stuff. Those are the big ticket items, and also like the year of the roof, hot water heater, just to make sure that you're going into a home that isn't going to cost you thousands of dollars to repair 2 months or even like 3 months down the line. This is where your agent's connection can come in handy, so that they have inspectors and contractors who can go to the house and give you estimates for those repairs. This way you have better negotiation tactics when you go to the seller and say, well, this is wrong with the property and this is how much it would cost to fix it. Will you cover it or not? Once you completed the inspections and negotiated on any repairs that you want fixed, your due diligence period is coming to an end. There's no other time besides now for you to back out of the contract or change your mind without consequences. Your earnest money will be forfeited after the due diligence period, and now you're pretty much just waiting for the final approval from the bank or lender. The finance and appraisal contingency is from the bank or lender to verify that the property that you put an offer in on has the correct market value. So if you put an offer on a house for $500,000, the bank is going to be sending an appraiser to justify if that is the right price in the market. So the appraiser is going to look at past homes that have sold in the area compared to the house that you're looking at for the price per square footage, the condition that the property is in, and the location. There are 3 things that can happen when their appraisal report. It can be below what you put the offer in at, it can be right at what you put the offer in at, or it can be above. If it's below, that means the lender is only going to give you the amount of money at what the appraisal said that it's worth. So if you put your offer in on a house for $500,000, but the appraiser said that the house is really only worth $480,000, that's how much the lender is going to give you for the loan. So you're going to have to come up with the difference of $20,000 to close on the home. You can either come up with that difference out of pocket or negotiate with the seller to lower the price to $480,000, and you can close on the home with no problems. If the appraisal report comes back at $500,000, everything is good and you can just move forward with the loan. If it comes in above $500,000, that's even better. That means you're closing with equity. So if you're buying the home for $500,000, but a appraiser says that the value in this market is $515,000, you have $15,000 already in your equity as you're closing on your home. And that's best case scenario. Once you have the appraisal report and you have either negotiated to lower the price or you're good to move forward, you're basically just going to be verifying your income to make sure that you still have steady income coming in and you haven't made any drastic changes in your credit history. There will be more documents and more verification that the lender will be asking of you, but it's basically just finalizing everything before you close on your home. From the beginning of when you submitted your offer to the end of the financing and appraisal contingency, it's usually around 14 to 21 days. So make sure you don't make any drastic changes in your income, make any payments, or open any new credit during your whole home buying journey. Once everything has been finalized with the bank, you'll be getting a clear to close, which means you are fully set and fully approved to close on your loan. So a little bit of closing prep. Before you close on your home, you'll be getting a loan estimate from the lender or the bank, which fully breaks down how much money you'll be paying each month for your mortgage. So when you pay for your mortgage each month, it's broken out into 4 different segments: principal, interest, taxes, and insurance. Usually when you pay your taxes, insurance, and interest, it all just goes into your escrow, so you don't have to worry about having a separate money set aside. You'll also be getting a closing disclosure which states how much money you'll need to bring to the table to fully close on your loan. It'll have a breakdown for all of the lender fees, all of the property taxes that are prorated from the date that you start owning until the end of the year, your down payment, your purchase price, and any other fees like closing with the attorney. You want to make sure you ask questions with the lender and the attorney to make sure that all of those numbers are adding up properly and you don't have any concerns with what is on the statement. Because once those numbers are finalized, you'll have time to wire that money to the closing attorney to have an even faster closing time. With your agent, the day before, even the morning of your closing, you'll be doing a final walkthrough of the property. You want to make sure that the seller has moved out and that there is no changes in the condition of the property from when you did your first showing and inspection to closing day. Your real estate agent should also remind you to set your water and power and internet up for when you move into the house and all of the utilities before you close on the home. It's closing day. The closing attorney and your agent will guide you through the paperwork that you'll need to sign to say that you are now a homeowner of your property. Congratulations. I hope this information was helpful. Let me know if you guys are still stuck or have any questions about the process, and let me know down in the comments how I can help answer any questions or go more in depth in a later video. My name is Sydney Jett, your real estate helper.